Hey, how's it going everybody? Welcome back to the LAGFOREX channel. Now today I just wanted to make a quick video in this Learn to Trade series. It's not going to be as long as the others, but it's just a nice little methodology within the smart money concepts approach to the market. It also ties in the 3-box strategy video that I've gone over so many times. Now this is such a good foundation for a lot of the videos that I will be making within this Learn to Trade series, because it basically gives you that understanding of our 3-step approach into that market, exactly what we need to see in order to place a trade, and exactly what structure we need to be delivered to us in order to do so. So I'm basically going to run through how we can implement the 3-box strategy or the 3-box method within a top-down analysis. So as I run through this, it's just going to give you a great method to use when you do a top-down analysis, and if you quite simply just follow this, you will find that your top-down analysis is so much easier and you can gain that directional bias in such a better and more efficient way. So to anybody who hasn't watched the 3-box video and is unfamiliar with what it actually is, I've just done a little bit of explaining here on the screen. So the first step being identifying your structure, so identifying the impulsive wave within that current trend. Secondly, we have points of interest, so looking within that impulsive wave where there are unmitigated positions that price needs to come back to, mitigate before then reversing and taking it to the next leg within that trending market. And then finally we have entry confirmation, which I personally use Wyckoff, and what this means is that when price does approach one of our points of interest, we have a set rule, a set list that needs to be followed for us to execute a trade. Now this may be fractal structure, but we use the mixture of fractal structure and Wyckoff. So on the right here, you can see just a quick little draw up of what this is. So we see that we are within bullish trending market and uptrending market. We are actively breaking the highs and protecting the lows. So what's happened here is we have this correctional wave. If I just get the draw tool out, this is our correctional wave within that. Now we know that for the market to have been sold back down, and in this region for us to reverse the market, we had to have positions open by the smart money operators in order to make this happen, in order for them to reverse the trend at that moment. Now, because we know this, we know that price is going to want to come back down to this area, mitigate and close those positions before we continue higher. So we've identified the most recent impulsive wave, that's a blue box. Within that impulsive wave, we've taken that down move, so the last down move before the up moves, that's the demand zone, so our point of interest. And as price is trading back down, we've had the shift from weaker to stronger hands, we've had the manipulation and creation of liquidity, and then the reversal of the market. Now that is exactly where we would get in on the trade. Now, enough explaining, I'm going to dive into the live markets. I've just got the euro to US dollar here just because it's one of your most popular pairs. So I'm going to show you exactly how I would do it on this pair. You can go off, try to add this or try to apply this onto any of your own markets using this 3-box strategy, and you can see exactly how I have success with it, and hopefully you will too. Okay, so looking on the screen now, we've started on our higher time frames, so the weekly time frame, and within this we have an impulsive move up. So this is A to B, so our extreme low to our extreme high. So if we get our rectangle tool, we go from our extreme low of this impulsive wave to the extreme high. We highlight that as our impulsive wave. Now we look within this wave, where do any positions lie? Where do any unmitigated positions lie? So we actually have 2 that I'm seeing. Now we have this last sell to buy candle, which is going to serve as one point of interest, and then on top of that we also have some position in here. Now what I'm going to do is I'm just going to drop down to the daily just so we can identify these points of interest a bit more cleanly. So looking in here, I would probably keep that one the same. You know, this is really our last down move, so I would refine this zone here. This is the major last down move before the up moves. We'll just drag that along, and then also within this there's that area I was talking about in here. So we find that last sell to buy candle, which would be this. They're the 2 points of interest that I would have drawn out. Now I know it's obviously easy to say in hindsight, oh yeah, I would have done this, and now we can see that it's played out. Now this isn't because price has played out here. It could have easily just disregarded that to come and fulfill this point of interest. Now that's completely fine. This is why we draw up multiple zones, because it is going to be multiple areas within an impulsive wave where the criteria for a point of interest is met. Now, we cannot guarantee or say that, okay, this is definitely the best zone. There is no best zone. We just have to have a 3-step approach in order to ensure that if price isn't to reverse in that zone, we aren't involved in that market. So that's exactly why we have step 3, Wyckoff, because if we weren't to see the reversal here, we wouldn't get involved. So if price was to just continue and just blow through this, we wouldn't have been given any entry confirmation, no Wyckoff schematic would have been formed, and we therefore wouldn't be involved in the market. So longer term, or the highest time frame bias, is that we want price to continue trading down into these lows to mitigate this position. So as we drop lower, we understand that we can try to be a buyer in this move down in order to take price to here, because realistically there is no reason for price to reverse higher until it does reach, fulfill and mitigate this area. It's not to say that price definitely won't, it is just extremely unlikely. Now, one thing I do actually want to focus on is this region in here, just to show you how we would have been able to get involved in this position here and how we would actually manage that trade. So if we play price back to this point, and then using a rule that some people say, so if you pick one time frame to identify structure, you should use a time frame X amount lower in order to get your entry confirmation or view fractal structure. Now, different people have different ways. Some people say, 30 times less, 15 times less, 10 times less, whatever that is. Some people may just stick, I always use the 5 minute for entry confirmation. Now, I will typically use anything between 15 to 30 times lower. So the day, there's 24 hours in a day. So I think the 1 hour time frame will be perfect to view in here for any entry confirmation. So there we go, onto the 1 hour. Now, this isn't the cleanest accumulation you may ever see, but if we just really look at what's going on, we have the selling climax here. So this is the first evidence of demand entering that market. I've run through many Wyckoff schematics by now, so you should understand exactly what I mean when I'm marking these up. Automatic rally. We have some secondary testing here. It's now evident that we have a level of support being introduced into the market. There is liquidity being built. And now as we push through this newly created liquidity zone, what we're doing is A, manipulating people out of the market, but B, the smart money operators are also creating or opening those large positions that need mitigating. So in order to create that spring, they've had to do that. They've had to open those large sell positions to bring price down. And now because we know that, we could have looked inside of there and looked for the final sells before we reverse that market. Now, even more fractally again, you can actually see that within the area where the spring was created, we have the same thing. We have that inducement or the creation of liquidity at this region there. And then what happens, we have a high volume sell before the market starts breaking upwards. Now, we could have taken that high volume sell as a zone. So what we could have done is we could have looked at this and we would have seen that quite simply, we set this high in the market. We had this manipulation of this area, this injection of momentum, and then we came and broke this high. So we've now had an S&D flip. We've reversed the trend, set this high in the market. Now what that means now is that this move up becomes our impulsive wave or our blue box or step 1. And then within that impulsive wave, we have the final sells before the buy. So we'd wait, we'd see if price was to come back down and trade into this region. Eventually it does, it taps in, and then we move onwards. Now, this is exactly where I would have looked to get in on the market. Now, that's not to say that everybody would have seen this. Maybe it was outside of your trading sessions. So how could we have been involved if we were to miss this? Now, moving on, I don't know how price plays out from here, but I'm just going to assume that we can do the same thing again. We can identify this as an impulsive wave upwards, and then we can look within that impulsive wave on the last down move. So this would be our last down move. This would be our point of interest. We can look inside of that point of interest for some refined zones, which would be that for me, and look to try and find some confirmation from here. If we play price out, we'll see if price does actually eventually come to tap this, no it doesn't, price takes off. That's completely fine. You will find this sometimes with those Wyckoff schematics, because we've now had that shift, that S&D flip. What's happened is so much demand is in the market, and it's so much harder for price to cause a reversal and a move lower. Now what this is an example of is a rally based rally. So we have our rally up, our base, and then another rally. Now if any of you have seen some of the other videos, or maybe you've purchased the Beating the Banks course, you know that this is a very aggressive type of structure, and it is typically seen straight after a Wyckoff schematic. Now what this means is it's just harder to be involved in this market on those buy positions, which is where that pressure is then on you to have caught that original move that we could have been involved in. However, we got massively sidetracked there, just showing you what was going on. But now looking where price is now, as I said, we want to try ideally and be a seller until price reaches this area. So if we now drop down, I'll go down to the 4-hour time frame. We can start looking inside of this. Now straight away to me, we have a large impulsive wave that was created from this move. And then we have a few different areas within here where we have some supply and demand zones. Now the main ones I'll be looking at is this major up move in here. Remembering that this is our blue box, our impulsive wave. This is our point of interest. This could be refined further. I mean, there is a buy to sell in here that could be refined as another point of interest. Now within that, of course, we do have intermediary ones. So imagining that again, price was here, we didn't know what was going to happen. The two zones I would more than likely be watching would be this one, and then this upside one I have drawn out as well. The reasoning for this is because right here we've had a major pushback up, which has cleared a lot of liquidity. Now when we do have these high volume moves after the creation of liquidity, it typically does confirm to us smart money presence, which does again then confirm unmitigated positions or areas in the market that hold interest to us. So these are the two zones I would have drawn out. We'd wait for price to then play out. We see that price does kind of tap into it, show a reversal. Maybe you could have found confirmation on a lower time frame, maybe not. But then straight after, we disregard this zone. So now to me, I'm not worried about this area. That is no interest to me. I will now just be waiting for price to play and trade back up into this region at the top in order to get an entry. Now where price is now, we are sort of just consolidating now in this region. What we're doing is creating a lot of upside and downside liquidity. We are getting a lot of people confused on what the future trend of the market is. A lot of retail traders into the market ready to be manipulated out. The way I'm seeing this is it's more than likely just going to be an accumulation to take price back up to this, so that we can then get those longer term sells down into that original demand zone we had drawn out. So just looking into this region of consolidation now on the 1 hour time frame, I've replayed price just to show you exactly what it is that I was looking at. So what we've had here is we've had an upside break of structure, which tells me that we could be ready to start running upside liquidity. What we therefore look at is this as our impulsive wave upwards, so our step one. And then within this we have a large sell to buy, so this wick here being that sell to buy, therefore being our point of interest, our demand zone. I'd just wait to see if price delivers down into this. Okay, we've tapped in. Just let it play out a bit more just to see if we can get. Okay, there we have it. We've got some displacement. Now we're on the hour, so that is 60 minutes. Let's try and go down to a 3-minute time frame. I just want to see exactly what's happened when we have tapped into that point of interest. So looking inside of here, we could argue that we've had an accumulation, just because what I'm seeing here is this area here is a much lower time frame area, or much lower time frame accumulation that we could have been involved in. But quite simply, we've had a selling climax, automatic rally, secondary test. Now here we have a level of liquidity built. Now price is reacting off this a lot, and then straight after we have this high volume push through, and then we displace upwards, breaking the highs. Now what this is telling me is that price is now ready to start moving upwards. But on top of that, we have a high volume sell candle that is yet to be mitigated. So we take this final sell, We'd wait to see if price was to mitigate that. We already know that it does because we've got the price data. Price taps in. We could therefore be involved in that. So that is exactly how we could have been involved on that movement. Moving forward, price just continues to consolidate in this region. And now taking this as an impulsive wave, we could argue that this wave is not yet finished. The impulsive wave hasn't set the high that we wanted to, with this being a final target. However, because we have got confirmation of bullishness, we can therefore still identify the last sells as a point of interest, set those alerts there, wait for price to deliver into those, trade down into those, and then wait for our step 3, so Wyckoff, like we have in here, the structural shift, which is quite simply the fractal structural shift. So looking on those lower time frames for some sort of break of structure, so we trade down into that point of interest, we have some creation of liquidity, we then clear liquidity, introduce demand into the market, and then once we break this high, we've now had an S&D flip, so we're now looking for demand zones rather than supply. Maybe we could identify a last sell candle within this as this zone. We see price tap in and then take off. Now, so I hope you've all enjoyed this. I hope you're able to make use of the 3-box strategy within your top-down analysis from now on. Any feedback in the comments is highly appreciated. With that being said, I will see you next week in the next Learn to Trade video.